Hi, I'm Vedant, and in this video, we're going to learn why index funds grow and how to pick one. In case you don't know what an index fund is, I suggest you watch the previous video, how and why I started investing in the stock market at 18. This is because in under 10 minutes, we have discussed it very thoroughly, the link to which is in the description below. When you invest in an index fund, you get units in return, and each unit has a price called net asset value or NAV. Suppose you invested 1,000 rupees and the NAV is 400. This means that you get 2.5 units in return. The value of the NAV doesn't matter, but the pattern that it follows is identical to that of the index. Before you put your money in an index fund, let's understand why it grows. Well, it grows because of increase in consumption. By that, I don't mean just eating. I mean more and more people accessing electricity, internet, shopping online, healthcare, accessing banking services, and so on. And apart from all this, the total population itself is growing. I think we have understood that consumption is increasing, but consumption can increase if there are more and more products and services existing to be consumed, which means businesses are growing, banks are growing, hospitals are growing, internet facilities are increasing. Therefore, these businesses are part of the index and these grow with time. It takes many years to observe this growth. For example, 10 or 15 years ago, having a touchscreen phone was probably a luxury, but today everyone has it. In index funds, there are two kinds of plans, a direct growth plan and a regular growth plan. You want to be taking the direct growth plan. This is because this does not include any broker who will charge additional fees in between. There are two strategies to investing in index funds. One is called the SIP or Systematic Investment Plan and lump sum. In an SIP, you set aside a fixed amount every single month to be invested. An SIP is a brilliant strategy. Don't believe me, believe him. Well, this right here is Warren Buffett. Let's see what he has to say. He is the world's most successful investor. His net worth exceeds $70 billion. A great strategy is to buy stocks consistently over a lifetime and not worry too much whether they go up or down in any given month or year. This is the graph of Nifty, the index of the National Stock Exchange. Let me explain why buying consistently works by actually doing the opposite. Let's assume I put in a lot of money here. Well, that's what most people do. They look at the last 5 6 years. Well, wow, the market has grown so much. Let me put a lot of money at once. They get happy for some time. The market grows, but it also crashes eventually. And when it crashes, they get very scared, they panic, and they sell for a loss. Well, you might think anybody with common sense wouldn't do that, but trust me, looking at your hard earned money go into losses for more than a year or maybe even 2 years is extremely painful. It is something you would probably want to get rid of as early as possible. So, what you would have wanted to have done is bought the market consistently, whether it is going down or up. So, you get a lower average value. And that is important because over long horizon, it grows. But lump sum can also help you boost your returns. Let me explain how. When you buy more aggressively during a crash, your average value becomes much lower, and that helps in the long run. Let's discuss the actual parameters that you need to look out for while selecting your index fund. Make sure you wait till the end because I'm going to tell you the one I use at the end. I'm not giving it right away so you can analyze for yourself and possibly find a better one. Coming to the actual parameters that go into selecting your index fund. The three main parameters are the expense ratio, the exit load, total amount the fund manages or fund size, also known as asset under management or AUM. The most important is the expense ratio. This is a percentage of money the fund charges as fees for having invested in Nifty on behalf of you. The lower it is, the better. The calculation is slightly confusing and ugly, so let me capture its essence with a simple example that gives you an idea of how it is charged. Let's assume you invested an amount of 1000 rupees and the expense ratio is 0.1%. At the end of first year, assume your money has now become 990, which we know can happen. The fees will be calculated by taking 0.1% of 990, which is 0.001 into 990, which is equal to 0.99 rupees or 99 paise. Let's assume at the end of year 2, the present value now has become 1010 rupees. The fees then will be calculated by again taking 0.1% of 1010, which is 1.01 rupees. At the end of third year, assume your present value now has become 1100 rupees. The fees would then be calculated by taking 0.1% of 1100, which is 1.1 rupees. I want to say this again. This is not exactly how it is calculated, but this captures the essence and mimics the actual way very, very well. The exact way is the previous process is applied every day. We calculate the fee like before and divide it by 365. This way we get the fee for one day. Your total fee hence becomes the sum of all of these daily fees. It is calculated on a daily basis because you have the freedom to sell your units on any day. Therefore, the fund or AMC, asset management company, should ensure getting their fees. The fees they collect every year can affect your returns strongly over the long horizon. Therefore, you should make sure the expense ratio is low, preferably 0.1% or about 0.2%. Let's come to the exit load. On selling your units early, generally in less than a year, you are charged an additional fee. However, make sure the exit load is zero after a certain period of time. Larger the amount the fund is handling, the better in general. Preferably, the fund should be managing more than 1000 crores, which is also called as asset under management or AUM. Dividends are profits that companies share with their shareholders. Since the fund buys a piece of 50 companies on your behalf, they get dividends. Some funds let you take a dividend option, which gives you these dividends in cash form. But letting those dividends be reinvested would be ideal so your investment continues to grow. Let me briefly summarize all the points that we have covered. I'll pause here and give you some time to read them. What I have shared with you is a rough idea and some guidelines to select one for yourself. You may select a fund that has a slightly higher fees if it makes you feel safer. It's up to you. Something else you have to be aware of is an exchange traded fund. I know it's a lot of information at once, but trust me, it's worth it. The thing is, exchange traded funds are basically stocks that track the index. They move identical to the index as well. Some years back, they had a huge advantage on index funds. That is, their expense ratio was 0.05% also. It was much lower than index funds. Index funds used to be 1 to 1.2, 1.3% also 5 to 10 years back. Therefore, they had become very popular. But the problem with exchange trade funds are you first of all need a demat account. On top of that, when you buy and sell them, you also need to pay brokerage, and therefore now index funds are better because they have become more competitive and reduce their expense ratio substantially. I am sharing this little extra information as well so you have extra clarity and complete understanding of what you are doing and why you are doing. After you select the fund you want to invest in, you can go to their website, register and buy it from them directly. You can also use the help and support and contact them if you have any difficulty. So let me share with you which fund I invest in. I invest in UTI Nifty Index Fund Direct Growth. You can go check it out yourself. I won't give the specs here, so you start searching. I just want to say this again. You have to do the research yourself and find one that suits for you. Don't follow anyone blindly. Make sure you smash that like button, subscribe with that icon right there, and let me know in the comments which index fund you went to with. What are you waiting for? Go and invest.